So what's the big problem with wealth creation? How do people like us, who didn't inherit a boatload of money, who are investing and building wealth from our own blood, sweat and tears, how do we invest in a way that gives us remarkable results and become financially free before retirement age? I don't know about you, but I am sick of hearing from wealth gurus and experts who don't walk their own talk and prescribe strategies that are a one-size-fits-all approach. For self-made people like you and me, I'm here to tell you that you don't need to be superhuman or already wealthy to reach financial freedom earlier than 65. This is the Alternative Investing Podcast. Hi there, everyone. Welcome back to the podcast. Today is going to be a super fun session. I really want to respond to a couple of you that have sent me messages asking for more of a deep dive on private funds. So today what I want to unpack is what the three types of private fund investment strategies are. I want to pull apart what the private fund model looks like, why they're different to other strategies, some pros and cons. I want to take you through some examples deals. And I really want to kind of send you away with a couple of lessons to think about in terms of, really getting clarity on whether it's a strategy that you want to, embrace over the coming years. Where I'd love to start is I just want to start with talking about what private funds have meant to me personally. They have really been the holy grail of strategies to discover, one of my favorite strategies now. And in essence, what accessing private funds has allowed me to do is tap into really premium opportunities, but with a huge sleep at night factor. I've got trusted advisors or deal makers who are running those funds for me and others that are, extensively experienced, have a proven track record. I know, like, and trust them. And they give me a high level of control, there's a high level of communication, but there's absolutely no way that me as an individual investor would be able to tap into even a fraction of the quality of deals that they are getting across their desk on a daily basis. I guess first and foremost, what I love about private funds is that I'm tapping into a caliber of deal flow consistently, and I don't have to do anything for it. So if you're someone who doesn't necessarily want to participate in the day-to-day vetting and management of deals, and you just want simple reporting and that money to just turn up like clockwork in your bank account, then private funds are really an awesome strategy to be involved with. If I were to describe from a mechanics point of view what the essence of a private fund is and how it distinguishes itself from something like a real estate investment trust, a REIT, or, a hedge fund, what's really important to understand is probably not so much the structure of it, but what kinds of deals are available to both. Private funds essentially are where a group of investors pool their money with a particular deal maker, and then that deal maker distributes or allocates capital across a series of separate investments. And depending on the mandate for the fund, the purpose of the fund, it could be houses, it could be unit complexes, it could be self-storage facilities, it could be business lending, it could be any combination of a whole bunch of things. The difference between what I call private funds and what you see on the stock exchange as real estate investment trusts, because you could argue that the same principles apply there, is that these private funds are much smaller vehicles. They are run by individuals or teams who are looking for opportunities in the market to create alpha, meaning a much bigger return than what is available to either individual investors at one end or the real estate investment trusts. The thing to understand is when you're a hedge fund or a real estate investment trust, you've got hundreds of millions of dollars often that need to be invested or deployed into specific deals. And what I've witnessed when I look at the way that these real estate investment trusts operate is they have no choice but to acquire very, very large assets, big assets. And when I look at the sorts of returns that they are getting on those assets, often they are quite compressed. So they're buying premium assets, no question, but with a very compressed return. So if you look at the sorts of returns that you get with real estate investment trusts, frankly, they're not setting the world on fire, and they've varied from somewhere around the 4 to 6% mark. So, that's okay. It's better than having it sit in a bank. But what makes me really excited about private funds is depending on, the fund that you're talking about, it's very easy to get returns of anywhere from say 8 to 22% net after expenses. And the reason that those returns are available is that these fund managers are accessing a section of the market that's probably slightly out of the reach of individual investors, but just too small for those big hedge funds and real estate investment trusts. So it's definitely a market which I would say is very inefficient. And this is probably true of all of my alternative strategies, but specifically for private funds, what they're trying to do is tap into a fairly inefficient market in order to get these amazing returns. If you think about a real estate investment trust, there's higher levels of compliance and regulation. They've got that bigger lump sum of capital to deploy. And, they do have to compromise on their returns. They overlook those smaller deals, and a change in the unit price is how you get paid. The thing about private funds is they're really only known about in smaller circles. Depending on the deal maker, depending on the management team, they themselves can be quite fussy about who they let in as investors. And I'll give you an example of this. Some of the funds that I've participated in have, I would say kind of like they carve the structure into 99 pieces or 100 pieces. So they can only have 100 investors. And so they want people to work. And, that doesn't sound like a lot of people, but, that's a reasonable amount of people. But they want a relationship with each of those investors. They want to know that they're not going to have people who are difficult to deal with. And, because they are dealing with a smaller amount of capital, their ability to chase these smaller, more lucrative deals is really, really far greater than some of those bigger REIT fund managers. They have much more targeted methods of finding assets. And, unlike a publicly traded real estate investment trust, me as the investor, I have a direct line of communication to the fund manager, which, clearly I wouldn't have if I was buying something from a publicly traded market. So that's kind of the overview of the mechanics. And clearly what makes this really different to a lot of the other strategies is that you've got that, real diversified approach to asset acquisition. So even if you're all in on one particular type of asset, say, for example, self-storage, you could be buying across different geographies. You could be buying different sized assets. You could be buying, assets in that niche which have different levels of liquidity. You could be buying assets which need virtually no work, some that, that there might be improvements. So it's really important to understand that as distinct from, say, for example, a syndication where a group of investors put their money with a deal maker and the focus is on the purchase and improvement of a single asset. Private or public fund, these small private funds are really about multiple assets rather than just the one. In terms of thinking about when could these sorts of funds be worth considering, I think they're an awesome way to get to know a new market that maybe you don't have familiarity with. If you are an investor and you like the idea of being diversified across a series of assets, then private funds are a great choice. Obviously, like when we're talking alternative, it's that hands-free investing model. Really what we're saying is that, we don't want involvement in the day-to-day management of those assets, but we like having that direct line of communication with the asset manager. If you have no time, then, these private funds are an awesome way of developing passive income with very little work on your part, apart from obviously doing your due diligence when you first make that choice. When you've reached an acceptable level of capital base and you want to start turning that dial towards more passive income, then again, private funds are pretty much, I think, hands down, one of the most popular strategies inside of my mastermind anyway. that's kind of the when. When is it a good time to be thinking about it? If I were to give you some examples of deals, I have a good friend who is one of the most exceptional small private fund managers that I've ever met. He, at one point was an international chess coach. So just to give you an idea of how he thinks. And what's really exciting about the way that this guy runs his fund is he's really great at articulating his methodology for choosing assets. He has what he calls the 4 quadrants, and he's constantly talking about how assets fit into one of these 4 quadrants, one of these 4 buckets. So what I love about the way that he runs his fund is there's a high level of transparency. He's very clear on the fact that investors get paid first, and then anything above, like say, for example, an 8% preferred return that goes to investors, everything above that gets split, either 90% to the investor, 10% to him, 80% to the investor, 20% to him, or whatever. Like it's all just very nicely mapped out. And unlike your typical managed funds or your traditional financial products, where fund managers get paid no matter what, it's not necessarily performance based. And if there's one person that never loses out in those sorts of deals, it's the fund manager. In these private funds, one of the key distinguishing characteristics is that the better funds will always say investor gets paid first, I get paid after that. There might be a nominal acquisition fee whereas assets are acquired, because obviously there's a lot of time and effort that goes into those due diligence, but the fees they make are a fraction of what you would see in a traditional, even superannuation fund, to be frank. So, the way that the fund is managed is from a place of transparency. There is regular reporting. There's performance reporting. So, how are assets that have been previously acquired? Where are they in their life cycle? What's happening to them? So depending on the level of involvement that you want as an investor, you could basically just ignore all of that and just watch your bank account and just, or your statements and see what's happening. Or you get to participate at kind of like the coalface. You get to understand how decisions are being made. You get to watch over the shoulder as projects unfold. You get to look down the barrel of what's coming up, what kinds of strategies are working. The other thing that I really love is that I feel the better private fund managers are very well economically versed. I'm going to share this with you as almost like a side tip. Most of the guys that I know that become deal makers in private funds are expert investors. Like they are world-class investors. And they're all, the ones I know, they're all independently financially, free. They don't need to do this. After a point in time, I think once you have financial independence, your mind has to turn to purpose. And these guys, they love the play of money. They recognize that they're helping others. They are all about how can I be of service? And one of the side benefits I feel of being a participant in these private funds, it's a way to up-level your own knowledge and education around money and wealth. But one of the side benefits that I sometimes forget about because I take it for granted, but these guys are really good at interpreting economic data. And this particular fund manager that I'm thinking of, he will regularly do what, he calls them kind of market updates. And he'll share some of the key economic metrics globally and also in his own market so that you get insight into how he is thinking about what to invest in the future. Your inflationary rates and what is happening to wage growth and all those sorts of things can actually help shape his investment decision making for at least the next 6 to 12 months ahead. So it's a really important quality, I believe, for these fund managers to be well versed economically. And really what we're doing as investors is we're riding the coattails because we're getting early inside information on what we should be thinking about when we not only participate in their fund, but also our own investments more broadly. How should we be thinking? What are the ripples in the economy that we need to be mindful of, that we maybe should even be worried about? How do we adapt our portfolio over time to navigate turbulence? How do we deal with economic uncertainty? So, particularly in the private fund model, but also in my deal makers and trusted advisors in the other strategies, that ear to the ground, that capacity to hear tremors months, if not years before others, is really the inside information that will set you apart from other investors. So I know I'm kind of digressing there, but I really wanted to drive home that is really one of the things that I am most attracted to when I'm thinking about working with a particular private fund manager. So in terms of a sample deal, I'm going to talk to you about, one of the funds that this friend of mine runs. It is a diversified income fund. The sorts of deals that get done in this sort of fund are, lending deals, being the bank, fix and flip projects to a small degree, commercial debt, distressed commercial debt, multifamily, self-storage, residential portfolios, mixed use. The sort of projected returns can be, in this case, anywhere from sort of 8 to 16% net to investors. The preferred return on that particular fund is 7%, meaning the first 7% that is earned by the fund each year goes to the investor first. Management fee is about 2%. And then there's a performance split, meaning above that 7% return, everything above that, there are A units, B units, and C units. The A units will earn 80% of all of the returns above that 7%. The B units earn 70% and the C units earn 60%. Distributions are quarterly. So the real, when I come back to the title of this podcast, which is the 3 types of private funds, what I really want to distinguish just at a high level is that you can have funds that are income funds. At the other end of the spectrum, you can have funds that are growth funds. Now, obviously, the mandate for the growth funds is not so much to deliver regular cash flow, but it's an asset improvement play where over a period of anywhere from kind of, I'll say 2 to 10 years, but typically 3 to 5, they will acquire a series of assets, either move them through some kind of project life cycle to force the appreciation to create a higher value, either sell or refinance them. So obviously the income funds are about deals that produce regular income. At the other end, you've got these capital funds or growth funds, which are all about creating forced appreciation in assets. And I want to really emphasize forced appreciation. For those of you who haven't heard me talk about that before, one of the things I talk about is that what I love about the space of alternative is these deal makers know how to make money whether the market goes up, down, or sideways, unlike traditional investing where we are banking on a rising market. So with these growth funds, it's not that they're sitting around waiting for organic growth or they're waiting for a rising market. What they're saying is, in today's dollars, I can take an asset, I can tweak the asset by making some either minor improvements. I'm not taking on construction risk. I'm not worried about labor and the cost of materials. I have a detailed project plan to help me understand how to improve that asset. And then I've got plan A, which is I'll refinance, plan B, which I'll sell, plan D, it just goes on and on. There's all these exit strategies. So at the end of all of that, these assets generally do produce really strong cash flow. So you've got all these different ways of managing the risk on each of those assets. But the point I want to make is you've got sort of, the income and growth funds. And in the middle, we've got what you call hybrid funds. So the hybrid funds are those that maybe do a little bit of both. You can expect a bit of income, but there's also a capital appreciation play, either through improvements or, basically just taking advantage of a particular opportunity in the market. So the thing to understand about hybrid and growth funds is the income can be a bit lumpier. You're still talking exceptional returns. And what I've witnessed, particularly in the last 12 to 24 months, is that growth funds will tend to have a higher rate of return. They often have phenomenal depreciation benefits, meaning tax advantages. If you're someone who doesn't necessarily need the income today, you're happy to wait 2 to 3, maybe 5 years to get maybe a 15 to 20% net return per annum, then growth and hybrid funds are possibly a fit for you. At the other end, if you're someone who is just looking to develop consistent income, then that diversified income portfolio could be a better fit for you. So hopefully that's kind of given you a little bit of an insight into the 3 types of funds. I really want to drive home, the pros and the cons. The pros of private funds are that you are getting access to leverage, meaning bank finance, through the deal maker. You don't have to do anything. So there are some deal makers that will access leverage in order to amplify returns and others that choose not to. Projects are secured by real property. In fact, obviously there are lots of types of private funds. There are private funds that I've invested in the past, which are not backed by property. But over time, I've gradually weeded those away, and I'm focusing predominantly now on those secured by real property because, for my comfort, that just feels good. And I would encourage you to think similarly, because when there's a solid asset there that isn't hugely volatile, that gives another level of protection versus, unsecured lending or things like that, where you don't necessarily have a bank of or a pool of assets to back it up. No day-to-day involvement. That's definitely cause for celebration. Regular distributions. You can have that preferred return model. As I mentioned earlier, I get paid before the fund manager. Access to deal sponsors through your fund manager. I don't have to go searching for the deals. They have their network of deal sponsors that bring deals to them, or they are in markets where they have relationships where they can just tap into deals as they need to. They're simple to execute. The paperwork around most private funds is fairly straightforward. Huge time leverage for me as the investor. I don't have to deal with tenants and toilets, no tenant management whatsoever. And I love the transparency of reporting. I love that regular reporting. For someone like me, while I don't necessarily like that day-to-day management of deals, I love getting, real-time updates as to what's happening. This friend of mine that I mentioned before that runs this particular fund, he's such an awesome dude. And one of the things I know he's great at is he doesn't sugarcoat anything. So if something goes wrong, he just kind of says it as it is. But he says it with, an element, because, things go wrong, of what the implications are. And usually, he's already designed a solution for it before, there's anything to even really report. On the risk side with private funds, it's really important to understand that the experience and quality of the fund manager is everything. If you invest with people who are sharks, if you invest with people who are not transparent, who do not have track record, who you do not know, like, and trust, that by itself could be your undoing. One of the reasons that people come and join Freedom Warrior is they're looking for the safety of being part of a tribe of people who have a proven track record where the deal flow is vetted. So if that's not for you, then you need to really make sure that you do great due diligence on the fund manager themselves. Second thing is, obviously, you have no day-to-day control over the project management. You have no control over the asset selection. You need to understand the loan to value ratios, meaning you need to understand how much leverage is your fund manager planning to apply to the deals that they do. I know I've spoken to a number of fund managers who are veterans in the industry. One of the things they've told me is that there are hundreds, literally hundreds of fund managers out there, people who start funds. They get good at a little sector of real estate and then they think, this is easy. I'm going to start a fund. Those funds come and go. They get into hot water. They over leverage. They choose the wrong deals. They don't have good underwriting, meaning protocols for deal selection, and they don't last. So the problem for you as the investor is, how do you distinguish between the two? So it's really important that you learn to ask the right questions. I have, in fact, done another podcast episode, which is all about doing good due diligence. So if you want to know more about that, just go and find that. It's really important that you understand the documentation, you understand how they make their money, you understand the impact of inflation on all of this stuff. So, for example, if you are going into a fund that is predominantly a lending vehicle, then, it's not really going to be a great hedge against inflation. Whereas if you're going into a private fund which acquires assets, equity, then, in theory, those assets should rise with inflation. So that's partly your hedge against inflation. The other risk to consider when it comes to private funds is, depending on the fund structure, your ability to exit might be really, really strict. So that's kind of like the cons, if you like, in a nutshell. I really do want to drive home that you need to do your due diligence. You need to be well educated on what private funds are before you put a single dollar in. One thing I say to my guys in my group is, and I say this, half jokingly, half serious, but it's very common when people join Freedom Warrior to say, "Oh, Salena, are you going to tell me where to put my money?" And my response to that is, by the time you get to the starting gates, by the time you set yourself up, we build out a bit of a game plan for you, we educate you, you'll understand who's who in the zoo in terms of what your opportunities are, because obviously there's a buffet of deal flow that we've put together. By the time you kind of grasp all of that, you won't want my opinion. You'll just you'll find affinity with different people. You'll love the strategy. You'll love who they are, how they do business, and you won't want my opinion. So the understanding of how to do these deals, how they work, and who are the people involved is really critical. You need to understand the paperwork and you need to understand the rules around exit. Let me kind of summarize this for you. There's funds out there that focus on income. There are funds out there that focus on growth. And then there's the hybrid. You've got debt funds, people who go out and lend. You've got equity funds, people who accumulate assets. So you've got to understand those permutations. And certainly I'm giving you a very high level insight today. If you are a business owner who is looking for an armchair experience around your investing, private funds are definitely a strategy to consider. You need to make sure you have enough capital in play to access those deals. But again, imagine this. Imagine you have $1 million to invest or $500,000 to invest. What you're trying to do as a passive investor is break that lump sum into buckets. So if you, for example, took your $1 million and broke it into $100,000 bites, into those sort of 10 buckets, and then you put each of those buckets into a separate private fund. I'm not saying you would do this, but I'm just kind of illustrating that if you've gone into 10 private funds and each of those funds has a niche or a specialization in different things, and then within each of those funds, they have a dozen or more assets. And each of those fund managers has their own market that they specialize in, their own way of thinking, their own methodology for underwriting assets. Then can you start to see how the fabric that supports your overall wealth starts to strengthen? Your capacity to diversify is magnified. Your capacity to access better deals across the board is magnified. Your capacity to, diversify between income projects and capital projects and growth projects and debt versus equity, it all just magnifies. So you're left in a situation where I won't use the words bulletproof, because no one's bulletproof. Things can still go wrong. But if you have $1 million and let's be super conservative, and let's say that on average, you're earning 10 to 12% across the board net after expenses, you can start to see how you don't need to work too hard to start creating meaningful wealth from day one. So anyway, guys, I want to leave it there. If you're interested in talking about how private funds could be a fit for you, if I haven't answered something properly, if you've got more questions, please feel free to send me an email, salena@inkosiwealth.com. Until next time, I hope you found this useful and take care.
You've been listening to the Alternative Investing Podcast. If you're feeling frustrated that despite doing everything right in the property investing playbook and you're no closer to financial freedom, then head on over to inkosiwealth.com to learn more about how you can use alternative investments to catapult your investing income and blend strategies to shave decades off your timeline to financial freedom. See you on the next episode.